If the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money. So it kind of implies that there were some real problems at the LBMA. I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
In today's video, precious metals analyst Clive Thompson gives a straightforward explanation of what's really happening in the silver market. Physical silver inventories have been shrinking for years, industrial demand keeps rising, and the system that connects paper silver to real, deliverable metal is getting tighter than most people realize. When you put those things together, strong demand from solar and electrification, steady buying from central banks and investors, and a steady drop in available metal, you get a market where price has to do the heavy lifting. It's not a 1970s-style bubble driven by hype. It's a squeeze driven by real fundamentals and a market structure that's starting to strain. Silver prices have already reacted. We've seen new all-time highs and even brief trades in the high 50s before a pullback. These are not random spikes. They're signals that the market is feeling true scarcity. You can see this in the data. Lease rates have surged, London vault inventories have dropped sharply, and trading glitches have exposed how fragile the system is under stress. These are real, measurable shifts that affect how investors should think about risk, liquidity, and the possibility of delayed or failed delivery. One of Clive's big points is that the LBMA no longer has much buffer stock left. London vaults have shown years of declining inventories, and much of the remaining metal is either leased out or held by long-term owners, meaning it's basically not available for sudden new demand. When the small amount of metal that is available is being leased at very high rates, normal hedging becomes too expensive. That makes price swings bigger, squeezes more violent, and market resets faster and harder. It's one of the clearest explanations for the volatility we've seen recently. Beyond the immediate pressure on silver supply and the LBMA's tight vaults, Clive walks us through a set of connected risks that matter for anyone with savings. Record central bank buying of gold, rising fiscal deficits in the US, and the fast-moving rollout of state-backed digital currencies. If you care about being able to move or use your own wealth freely, Clive's clear advice is to consider owning allocated, real metal today rather than waiting. Before we continue, make sure you subscribe, like the video, and turn on notifications. These deep dive breakdowns are for viewers who want real data, not headlines, and your support helps us keep producing them.
The size of the move that we've seen has been unprecedented. Having said that, unlike the bull market we saw when the Hunt brothers were buying silver and took it up to $50 back in I think the early 80s or late 70s, which was a speculative mania, this one is driven by fundamentals. We're seeing, we've seen for the last 5 years a deficit in mine production compared with the industrial demand. And that industrial demand is set to increase, partly from electric vehicles, where the amount of silver required is about double what you need for a conventional combustion engine. And of course, we've got an accelerating move towards solar panels, which also are big consumers of silver. So there's quite a large deficit in silver, and the only way to suck out that deficit is through higher prices. But obviously, those prices have moved very fast, and that kind of makes it, at least in the short run, kind of speculative. It doesn't mean to say that the bull market is over, not at all. But often when these things happen, you do get a sharp and unexpected pullback before the bull market can resume and go to another all-time high. But if we were to take the speculative boom of the Hunt brothers, and I think there was another one a bit later, which wasn't so much speculative, but both of them took silver to around $50, and so this time we've gone to $50. But if we adjust it for inflation, The figure I've heard quoted, and I haven't double checked myself, is we'd have to go to $180 this time around to kind of make a peak similar to the ones we've had before. So, when you have large bull markets like this, they can often overshoot. So I'd be a fool if I said it's going to turn around tomorrow. I'm not saying that. It could easily shoot up again tomorrow or the day after. But at some point, when you've got this sort of move, there has to be a pullback. And I think from here on, it's not so much of a steady rise as we have perhaps seen over the last few years. We now go into a phase where the moves are more violent, perhaps 2 steps forwards, 1.5 steps back, 2 steps forwards, 1.5 steps back. And of course, if you're a person who doesn't feel he's got enough silver, the way to play the game is to ease in gently a little bit now, which is painful because you're buying at the all-time high, but keep some in reserve so you can buy some perhaps in 10 days or 30 days time. Might be higher, might be lower, but either way, you can't be sad that you paid everything at the highest price.
Do you see there currently being a supply squeeze on at the LBMA? And if so, what could the implications be on the silver market moving forward?
I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months. So that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money. So it kind of implies that there were some real problems at the LBMA. But one of the funny things about if you have a high leasing rate, silver will flow in, because people say, I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
We saw a freeze on all trading at the CME last week, I believe it was Friday, on what was described as a cooling issue. Are their systems really this susceptible?
Well, I'll tell you what I think in a second, but let's just start by saying it's never a great idea to trade a conspiracy theory.
Yeah.
So now, in this case, it obviously was rather convenient that things broke down just at the high point, just as it was hitting a peak. And in a way, one could say that maybe gave the shorts some kind of breathing space to figure out what they're going to do without getting margin calls while the silver price was hitting all-time highs. So they can't send out a margin call in the middle of the day or think about a margin call if there's no price to make a margin call. But what we did see, which was quite interesting, during the period when the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. So in one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on, but I have to accept that it is a possibility. But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion, but I'll put it down to randomness.
Clive's insightful analysis gives us the structural picture. What happens when the plumbing stutters? A temporary outage at a major exchange or a spike in lease rates is not an isolated technicality. It reveals where optionality in the system has been exhausted. When trading platforms halt or suffer outages at key inflection points, short-term market participants face margin pressure and short squeezes. When physical lease rates rise toward double-digit or even near 40% levels, the arbitrage between paper and physical breaks down and flows reorganize around deliverable metal rather than synthetic claims. That transition is not instantaneous, and it is typically accompanied by violent interim price swings, exactly what we have observed. Clive's view is blunt. We're still in the early innings of a gold bull market because macro forces, large deficits, the expectation of lower rates, and heavy central bank buying are steadily increasing demand for hard assets. At the same time, he warns that the coming wave of digital currencies changes how governments and central banks can influence money. If central banks issue digital euros or dollars that sit directly on their balance sheets, you may no longer have the same freedom to move money the way you do now. For Clive, that combination, a stronger institutional appetite for gold plus new digital money rails, makes owning physical gold today a strategic hedge against the risk that future digital systems will limit how people can use their banked funds. Now let's hear Clive explain how those monetary and geopolitical trends shift the outlook for gold and silver. This next clip gives his direct take on where we are in the bull market and why he thinks physical metal matters more than ever.
So what are your thoughts, and would you say we are closer to the beginning or the end of this bull market as it stands today?
Well, I certainly don't think we're at the end or even the middle of it. I think this is late beginning. In terms of what's driving it, well, we've got a lot of things driving it at the moment. Some of them have been around for a few years and some of them are relatively new. We've got the fiscal deficits in the United States. So let's face it, what happens in the United States is very important to the value of gold and silver, because the less confidence people have in the US dollar, the more they're going to look for alternatives. At the moment, there doesn't seem to be enough actions to address those deficits, which are set to be the largest ever on record this year. This year started in October. That's the fiscal year for the United States. So it's going to be at least 2 trillion of deficit, the highest ever. We've got lower rates coming from the Federal Reserve, or at least that's the opinion at the moment. Now that can change because I know it's not 100% certain they'll lower rates in December. But the opinion at the moment is we've still got lower rates coming. Then we've got central bank buying at record levels for the last 3 years. So central banks have shown over the last 3 years buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. And there's a good reason to want more gold. And that is, we've seen a certain weaponization of the dollar. And it doesn't really matter whether you're friends or enemies with the United States. You've got to think, what if I suddenly can't get my hands on, or I can't deploy my dollars for some reason? You know, there's been a lot of surprises in the last 11 months. If you know what I mean, surprises that people never saw coming, and a lot of seesaw, whipsawing back, they call it the taco thing, the taco trade. Trump always chickens that, but it's not really that. But the point is, you don't know where you stand from one day to the next. One day you've got a tariff, next day you don't, then you do, and then there's a retaliation from another country. So things are a bit chaotic when it comes to investing, and particularly relying on the dollar. So I think people are looking for something which can't be restricted, can't go to zero. So in that respect, gold is coming in. So then we've got the geopolitical events going on. That's not new. Geopolitical events have always been there, but obviously people think that there's a heightened tension at the moment. And that, again, is a reason why people would want to lay their hands on gold. When I say people, I'm talking about countries. And a lot of the buying has been coming from third world countries, like China, Kazakhstan, Poland, those sort of things. I don't mean to be derogatory to call them third world countries, not the Western countries, shall we say. That's kind of what I meant. That's kind of where the buying is coming from, countries which are maybe not, as of today, the greatest friends of the United States. They're not enemies either particularly, but, they're just, well, maybe some of them are, but they're just sort of saying, let's get some just in case. But I think there's also something going to continue to drive it in the next few years, probably out to 2027, 28, 29. And that's the coming digitization of currencies. We've got, starting next year, the rollout to start with of the digital euro, and that will go fully live the year after that. I don't want to go into too many details because it's a very, very long topic, but the long and short of it is, I think you better get your gold before you've got the digital euro arrives. I think that's my, and if anyone wants to know why, look at my last video, but really get your get your real gold before the digital euro arrives, because you will perhaps find that you will no longer be able to deploy your assets in the way you want your money in the bank in the way you want to.
What are the implications that you see if they do roll it out in the way that they are intending? Why is it that we need to have our hands on gold? What are we protecting ourselves from in that situation?
I don't know where they are, other than what they've said, which is they're going to roll it out. Obviously, I'm not a software engineer in that respect, and I'll just comment on this airport security thing. I mean, saying that it's not working properly. I wonder what they're playing at, because the technology, facial recognition, works 100% perfectly. I was in China about a month ago for 2 weeks, and I had to get my face scanned to go into the apartment block where I was staying. So as you walk into the area, it recognizes your face, the doors open. It knows who you are by your face. As you get to the building, the door unlocks because it sees your face. You don't have to press a button. You don't have to look at the screen. It knows who you are. And as you go into the building, it knows what floor you're going to, and the floor on the lift, the floor lights up. You can't press another button. It knows. So facial recognition works 100% perfectly. It can't make a mistake. So I don't know what the problem is in the airports. I really don't. But anyway, do I think it's going to come? They say it will, so you've got to go with what they say. And the real problem here, there's lots of problems, but let me talk about one. The limit of what you'll be able to put into your wallet will be 3,000 euros, or it might change slightly, but they say it's going to be 3,000 euros. That doesn't sound like a lot. And so as extra money comes into your wallet, there'll be an auto sweep into your bank account. And if you spend more than 3,000 euros from your wallet, there'll be an auto sweep out of your bank account into your digital wallet. Now, we've got to remember that digital euros are not the euros in your bank. It's like changing Irish euros for German euros. Looks like the same thing, but well, they technically are, or 100 cents for a dollar. It looks like the same thing, but it's not. The digital euros are a direct liability of the central bank. The euros that you hold in your bank are created by a roundabout method by the banks themselves, where they set it around hundreds of times. And the reason you can know that for sure is the amount of bank deposits is, I haven't got the figure, it's many, many tens or hundreds of multiples of the money which has been issued by the Federal Reserve, the liability on the balance sheet. So what you're going to get with digital dollars is a liability of the central bank to you.
Clive's central message is consistent and testable. Central banks are buying gold in large quantities, fiscal pressure is rising, and at the same time, nations are preparing new digital money systems. Taken together, those trends make precious metals more than a speculative bet. They are becoming a piece of practical insurance for people who value access and optionality over their own assets. If central banks continue to accumulate gold while digital currencies give states new levers over money, hard assets look likely to play a growing role in both sovereign and private portfolios. Silver sits at the intersection of two forces. Clive highlights, it is both an industrial metal, needed for solar panels and electrified vehicles, and a monetary adjunct to gold. That dual role makes silver particularly vulnerable when deliverable inventories shrink. When physical metal is scarce, price can spike fast. In that environment, holders of allocated metal are better positioned than holders of paper claims. On digital currencies, Clive stresses a practical point. Design choices matter. If national digital wallets are limited in size, if automatic sweeps move excess wallet balances into bank accounts, or if central banks can directly control digital liabilities, individuals may find their ability to use or move money constrained in ways we have not experienced under today's banking system. For Clive, that is precisely why holding physical, deliverable gold can act as a safeguard against potential restrictions or sudden policy changes. In short, watch 3 things: central bank gold purchases, physical inventory levels for silver, and the details of how digital currencies are implemented. If those trends continue as Clive describes, the case for owning allocated metal becomes easier to justify. If you found this breakdown useful, please give us a thumbs up, subscribe, and share this video. It helps push this research to more viewers who are trying to make sense of the biggest monetary shift in decades. And let me know in the comments what you want the next deep dive to focus on: silver supply, central bank flows, mining equities, or the coming digital currency dystopia. Thanks for watching.